Continuing on with Chapter 2, let's look at Lesson 2.2, analyzing how transactions affect accounts. A couple of things to note with this is that throughout Lesson 2.2 and 2.3, they're pretty much using the same exact transactions that you saw in Chapter 1. Same thing, right? Michael Delgado invests $2,000 of his own money into his company. Michael Delgado spends cash to buy supplies, spends cash to buy prepaid insurance, and so forth. And so these ones, Lesson 2.3 deals with transactions that affect owner's equity. Lesson 2.2 deals with some of those more general ones. So it's the same exact transactions. We're just going to be writing them a little bit differently than we did in Chapter 1, but the same exact principles apply. The same sides are increasing and decreasing as before. As we go through these, each and every transaction that we're going to work with here, we're going to go through, and I want you guys to kind of think about these questions, because eventually on the test, it's going to look a little tricky, but you're going to have to do all these things. You're going to have to answer these 4 questions, all right? So with every single transaction you get, you should know which accounts are affected, right? Is it cash? Is it supplies? Is it accounts payable? Is it owner's equity? Is it a capital account? Like whatever. So which accounts are affected? Question number 1. Number 2, how is each account classified? All right. Is cash an asset account? Yes, right? Accounts payable is a liabilities account. Expenses fall under owner's equity. So you're going to have to classify different accounts to where they belong, assets, liabilities, or OE, which means owner's equity. 3, how is each classification changed? That's Chapter 1 right there. Which side increases? All right. And so we're still not even working with those debits and credits yet. Number 3 is just doing the same thing that you were doing in Chapter 1. Number 4 is looking at this idea of debits and credits. Remember, debits on the left, credits on the right. So for the stated amount of the transaction, where do they fall in the T account? We're going to continue on. There's going to be 2 T accounts for every single transaction, because just like before, you have to keep each side of the equation in balance. So when something happens in one place, it also needs to happen somewhere else to balance everything out. All right. There's a flow to it that keeps everything equal always as you go. All right. So before we kind of begin, let's talk real quick about what a chart of accounts is. This is a vocab, a big one for this one. So anytime you set up some sort of a business, whether it be a sole proprietorship or even corporations or whatever, you're going to have to list all the different types of accounts that you might have. And usually you're going to assign them some sort of a number system to it. It's not to say that you can't introduce new accounts as you go on, but coming up with this piece of organization before you even start is a huge piece of starting your own business, okay? A list of accounts used by a business then is called a chart of accounts, which looks like this. This is a chart of accounts for Delgado Web Services, that business that we've been working with. The terms balance sheets and income statements, balance sheets deal with that accounting equation, assets equals liabilities plus owner's equity. That is one type of a report that you would look at as a business owner to make sure that everything's in balance, pretty much. And then over on the other side, you have revenue and expenses, which are different types of accounts, right? They fall under that owner's equity, but they can be further classified when you're trying to look at an income statement, which basically shows your profit, right? Profit is revenue minus expenses, all right? How much money did you make in revenue and how much money did you spend conducting business equals your net profit for the year, pretty much. And so then moving on the next year, are you going to retain those earnings? That would fall under the balance sheet account still. So these 2 things work together, and we'll end up developing that a lot more. But just look at some of these different account names. We have cash, sounds familiar, petty cash, made for maybe smaller transactions, different types of accounts receivable, supplies, prepaid insurance, different types of liabilities accounts, accounts payables, right? And owner's equity, which we have Michael Delgado, a capital account, drawing account, which he would make withdrawals from, income summary, sales and revenue over there. So this is just a small example. Like I said, a really big business might have up to 50 to 100 accounts for sure, maybe even more. All right, Let's look at our first transaction. Received cash from owner as an investment. All right. You saw this transaction in chapter 1. You worked with it and took a test on it. And overall, you guys did really good with it. So don't be too intimidated by this. It's just, like I said, adding a little bit more. And keep those questions in mind, those 4 questions that I showed you on slide 1. So on January 2nd, we have received cash from owners and investment. So Michael Delgado invests $2,000 of his own money into his business. And so question number 1, which accounts are affected by this? Which accounts are affected? We have a cash account. Remember, when he invests money into it, obviously that cash has to go somewhere. So we have cash, the first account affected, and an owner's equity account, Michael Delgado capital account. All right, so those are our 2 accounts that are affected. Number 2, classify the accounts. Cash is an asset account. Delgado Capital is an owner's equity account. All right, that's question number 2. Question number 3, assets are increased. All right, remember when he puts that cash in, obviously it gets deposited into Delgado Web Services bank account. Their cash account goes up. All right, and owner's equity is also increased by $2,000. Remember, equal on both sides. Now our balances, like you were working with in chapter 1, are both $2,000 under assets and $2,000 under the right side, liabilities plus owner's equity. Question number 4, factoring in debits and credits. Remember, we have 2 different accounts that are affected here. We have a cash account and a Delgado capital account. All right, 2 accounts, 2 T charts, 2 T accounts here too. All right, so we're still working within the accounting equation in this big accounting equation, this big T chart, but we have sub T charts in here now, 1 for each account. All right, so cash, Delgado capital. Remember, debits are on the left, credits are on the right. Same thing over here, debits on the left, credits on the right. And you guys know from chapter 1 that when this transaction happens, cash does increase. Okay, so now you're just putting that word debit to it. So know that, remember, assets are on the left side. So that means that debits are also on the left side, which means that is the side that increases for an asset account. So you would say when he makes this transaction, when Delgado Web Services receives cash from an owner as an investment of $2,000, we need to debit cash for $2,000, which means we're going to increase cash by $2,000. Number 4, part 2. Remember, on the right side of the accounting equation, we have liabilities and owner's equity. Delgado Capital is an owner's equity account. And so we know that in order to increase this, because again, like in chapter 1, you looked at this, you know that when one side increases over here, we need to increase something over here to keep them equal. So now we need to credit, because owner's equity is on the right side of the accounting equation. Credits are on the right side of the T chart. And so we need to credit Michael Delgado capital account by $2,000. All right. So this is sort of just sort of a preview. It's sort of a simple thing of what you guys are going to get into. You're going to be doing this for chapter 2 and on the test. It's just going to look a little bit different, but you're just going to need to know that those debits and those credits, kind of what impact those have on different accounts. And the impact that those have on different accounts depend on which side of the accounting equation each is on. Second time, paid cash for supplies. You guys came across this in chapter 1 as well. When you pay cash for supplies, you pay cash, so your cash is going to decrease, and then supplies, which is another asset account, is going to increase. All right, so you're doing you're canceling. You're having a transaction that happens all on the asset side that's canceling each other out, therefore kind of maintaining balance between the accounting equation. So we're just going to, again, just like the last one, going to go back into this a little bit more in depth. There we have our accounting equation, but we have nothing over here on the right side because this is all happening under assets. We have our 2 accounts here, supplies and cash. So which accounts are affected? Question number one, supplies and cash are affected. What is the classification for each? Well, supplies and cash are both assets. Same thing, right? They're both asset accounts. Number 3, what is the effect? Chapter 1 review. Well, when you buy supplies, your supplies account increases and your cash decreases. That's the effect. Now, the real chapter 2 application here, question number 4, bring in those debits and those credits. So since these are both happening on the left side of the accounting equation, and you know that supplies need to increase, since debits increase asset accounts, we need to debit supplies for $165 because we need to increase those. So remember, we're working on the left side here, debits on the left, assets on the left of the accounting equation. So debits increase by 165. To cancel this out so that both sides of the accounting equation are still equal, now we have to credit the cash account, decrease that by $165. Okay, now after this, we still have balance between our accounting equation, assets still equal liabilities plus owner's equity. Next transaction, paid cash for an insurance. Pretty much the same thing that's going to happen with supplies. They're both asset accounts. You know that when you pay cash for something, your cash account's going to decrease, and insurance is always treated like an asset because you pay for it up front and you get to use it for the whole month before you pay for it again. So it's considered an asset. So it's going to be the same thing as the last one. Which accounts are affected? Question number 1, prepaid insurance and cash. Question number 2, what types of accounts are they? They're both asset accounts. Question number 3, what is the effect? Well, again, prepaid insurance, chapter 1 review goes up, cash goes down. Number 4, bringing in debits and credits. Again, we need to debit prepaid insurance to increase it. We need to decrease cash, so we will credit it. So again, when accountants are going to be talking about this stuff and you're going to be recording these entries, can you imagine how many entries accountants make? They make tons of entries going through this stuff. So this lingo becomes very common. So when something like this happens, you would say you need to debit prepaid insurance for $900 and you need to credit your cash account for $900. All right, that increases by $900, decreases by $900 because again, we're both on the left. Our accounting equation, assets equals liabilities plus owner's equity, still equal. Bought supplies on account. So now we're back on both sides of the accounting equation. When you buy supplies on account, question number 1, what accounts are affected? Supplies, which is an asset account. That's question number 2. And accounts payable to Canyon Office Supplies. So when Michael Delgado or Delgado Web Services buys supplies on account, they're not paying cash for them right up front. They're still getting the supplies, and they are going to pay back Canyon Office Supplies later. So question number 2, supplies, what types of accounts are each of these? Supplies is an asset account. Accounts payable is a liability account. Question number 3, what is the effect of each? Well, when you buy supplies, your supplies account is going to increase because you're getting something. You're increasing your supplies, so increases in supplies. But your liabilities are also going to increase because now you owe Canyon Office Supplies $220. All right. So question number 4, bringing in that debits and the credits. In order to increase supplies, we need to debit supplies. So again, supplies are on the left side of the accounting equation. Assets are on the left side. On the left side of the T-chart, we have debits, knowing that they increase. Over here, we need to increase liabilities account. We need to increase accounts payable. So we are going to credit the accounts payable Canyon Office Supplies for $220. So now we have our accounting equation in balance on each side of the big T. Paid cash on account. What accounts are affected? Our cash accounts affected, and our accounts payable to Canyon Office Supplies are affected. So remember in the last transaction, Delgado Web Services received supplies on account. They paid cash Now they're paying $100 of that balance. Remember, they owed them $220, but they're just going to pay off $100 of that right now. So what accounts are affected? We have cash and accounts payable. When they're paying cash that was on account to Canyon Office Supplies, they're paying down that liability. Question number 2, how is each account classified? Cash is an asset. Accounts payable to Canyon Office Supplies is a liability account. Question number 3, what is the effect, increase or decrease? Well, when you pay cash on anything, your cash is going to go down. And then to equalize our accounting equation here, we need to also decrease our liabilities because we owe Doug Auto Web Services owes Canyon Office Supplies $100 less now. Question number 4, bringing in the debits and the credits. So in order to decrease cash, we're going to credit cash to make it go down. Remember, debits increase on the asset side, credits decrease on the asset side. Other way around over here, debits decrease on the liabilities and owner's equity side on the right side, credit increases on the right side. So we're going to credit cash for $100, and we're going to debit accounts payable Canyon Office Supplies by $100, keeping our accounting equation in balance.